Hey everyone, and welcome back to the Safe, Simple, Sound podcast, College Planning Edition. I'm your host, Sam, and I'm really glad you're tuning in today. We're here to help you navigate the often complex world of personal finance with strategies that are, well, safe, simple, and sound. Today, we're tackling a specific tool designed to help families plan and save for education costs, something I know is a big priority for many of our listeners. We're diving deep into the Coverdell Education Savings Account, often shortened to Coverdell ESA. Our discussion today is based on detailed information on our website, safesimplesound.com. Link is in the show notes. Essentially, a Coverdell ESA is a dedicated savings vehicle built specifically for education expenses, and its main superpower lies in its potential for tax-free education savings. Two key things really jump out from the research. First, the money you save can grow completely tax-free, and withdrawals for qualified expenses are also tax-free. That's a powerful combination. Second, and this is a big differentiator, these accounts aren't just for college. They can be a fantastic K-12 savings plan, too, helping cover costs for elementary and secondary school. Understanding options like the Coverdell really speaks to our core beliefs here at Safe, Simple, Sound, particularly empowering you to understand financial choices and seize financial control over your future. Planning for education is a huge part of building that secure foundation, maybe even part of the lasting legacy you want to create. Ready to unlock the potential of tax-free savings for education? Let's get started with our first topic, Coverdell ESA 101. Let's be honest, when you think about saving for education, what are the biggest financial hurdles that come to mind? For many, it's the sheer potential cost, right? Whether it's kindergarten or college, those expenses can feel daunting, but the good news is there are specific tools designed to help tackle this challenge, and today we're kicking off a look at one of them, the Coverdell ESA. Consider this your Coverdell ESA 101. So first things first, what is a Coverdell ESA? Think of it as a dedicated education savings account. It's a special type of trust or custodial account set up right here in the U.S. specifically and only for paying the qualified education costs of a designated person, usually your child, grandchild, or another young beneficiary. It's like setting aside a specific financial pot just for schooling, with some unique advantages we'll get into. Now, you can't just label any old account a Coverdell. There are a couple of ground rules. It needs to be formally established in the United States with an IRS-approved entity. Think banks or brokerage firms. And importantly, when you create the account, the person who will benefit from it, the designated beneficiary, generally has to be under 18 years old. There's a key exception here for beneficiaries with special needs. For them, there's no age limit for setting up the account. Okay, here's the real headline grabber. The reason we're talking about this today, the tax-free education savings potential. Now, unlike some retirement accounts, the money you put into a Coverdell ESA isn't tax-deductible upfront. But here's the magic. Once the money is in the account, any investment growth, dividends, capital gains, happens completely tax-free. Imagine planting a seed in a special greenhouse where the sun helps it grow, but you don't owe any sun tax. Then, when it's time to harvest, meaning take money out for school, those withdrawals or distributions are also completely tax-free, as long as you use them correctly for qualified education expenses. How appealing does that sound when you picture those future tuition bills? Having that growth and the withdrawals shielded from taxes specifically for education costs can be a huge boost over time. Here's something that really makes the Coverdell ESA stand out from some other education savings vehicles you might have heard about, like 529 plans. While Coverdells can absolutely be used for college, university, or vocational school, they have this fantastic flexibility. They can also be used for elementary and secondary school costs, kindergarten through 12th grade. So if you're thinking about private school tuition, tutoring, necessary books, supplies, or even specific things like educational computer equipment or software K-12, a Coverdell can be a powerful K-12 savings plan. It's not just about saving for that far-off college goal. It can help with those more immediate educational costs, too. So just taking a step back, we've got a dedicated account, specific setup rules, that core benefit of tax-free education savings on growth and withdrawals, and its unique power as a K-12 savings plan. What initial questions does this bring up for you? Does this sound like something that could potentially fit into your family's financial picture? To wrap up this intro, a Coverdell Education Savings Account is a U.S.-based account set up for a beneficiary under 18 that allows your savings to grow and be withdrawn tax-free for qualified education expenses, including, uniquely, K-12 costs, making it a versatile K-12 savings plan option alongside its college savings potential. Your action item from today's segment is simple. Think about the potential future education costs for your child, both K-12 and higher ed. Does having a dedicated tax-advantage savings tool specifically for those costs align with your goals? Just ponder that for a bit. So, now that we know the what, let's get into the practical how. Specifically, how do you actually fund one of these accounts? Today we're talking about funding your future, Coverdell ESA contribution rules, and eligibility. Because, like any financial tool with tax benefits, there are some specific guidelines we need to understand. First up, the big question: who can actually put money into a Coverdell ESA? Well, individuals can contribute, parents, grandparents, maybe even the beneficiary themselves someday. But there's a key factor here, and it revolves around income. The IRS uses something called Modified Adjusted Gross Income, or MAGI, to determine eligibility. Think of it like your adjusted gross income from your tax return, with a few specific things added back in. Now, for the important part, the MAGI limits for education savings when it comes to Coverdells. To make the full $2,000 contribution for a beneficiary in a given year, your MAGI needs to be below $110,000 if you're a single filer, or below $220,000 if you're married filing jointly. There is a phase-out range, meaning your contribution limit starts to shrink. If your MAGI is between $95,000 and $110,000 for single filers, or between $190,000 and $220,000 for joint filers. And if your income is above those upper limits, unfortunately, you as an individual can't contribute directly to a Coverdell for that year. So take a second and think about that. Considering these income limitations, how might this affect who in your family could potentially contribute to the account? Maybe it's you, maybe it's a spouse, or perhaps grandparents who fall under those MAGI thresholds could step in to help fund the account. It's worth considering your family's overall financial picture. Oh, and it's worth noting that organizations, like corporations or trusts, can also contribute, and they don't face these same income limits. Okay, so that's the who. Now let's talk about how much. This brings us to the Coverdell contribution limits. And this one is pretty straightforward, but absolutely crucial. The maximum amount that can be contributed for any single beneficiary in a given year is $2,000. Let me emphasize that. It's $2,000 per beneficiary per year total. It doesn't matter if mom contributes $1,000 and grandpa contributes $1,000 into the same account, or if they each open separate Coverdell accounts for the same child. Once that child has received $2,000 in total contributions across all their Coverdell ESAs for the year, that's the limit. Think of it like a small, dedicated savings bucket for that specific child's education. It can only hold $2,000 in new contributions each year, regardless of who pours it in. Now that $2,000 limit, it's not huge compared to some other savings vehicles. How does that relatively low annual contribution limit influence how you might use a Coverdell ESA in your overall savings strategy? Maybe it's not your only education savings tool, but perhaps a valuable supplement, especially given its flexibility for K-12 costs, which we'll talk more about later. Next up, let's touch on some key mechanics, the specific Coverdell ESA rules around making those contributions. First, contributions must be made in cash. You can't directly contribute stocks or bonds, for instance, money in, and then that money can be invested within the account according to the options your provider offers. Second, there's some helpful flexibility with timing. You can make contributions for a specific tax year right up until the filing tax deadline for that year, not including extensions. So, for example, you could make a contribution in February or March of 2025 and designate it for the 2024 tax year, as long as you haven't already hit the $2,000 limit for that beneficiary for 2024. Third, generally speaking, contributions to a Coverdell ESA must stop once the beneficiary turns 18. That deadline flexibility is interesting, right? Does the ability to contribute for the previous tax year up until the filing deadline offer helpful flexibility for your savings habits? Maybe you get an end-of-year bonus or finalize your tax picture in the early months of the new year and realize you have capacity to contribute for the year that just ended. It's a nice little feature. Now, about that age 18 rule, there's an important exception. If the beneficiary is designated as a special needs beneficiary, those age limits, both the age 18 contribution cutoff and the age 30 requirement for funds to be used by, which we'll discuss in a later segment, do not apply. This is a really significant provision for families planning for the long-term education and support needs of a loved one with special needs. Finally, a question that often comes up: can you use a Coverdell ESA and another popular education savings tool, the 529 plan? The answer is yes. You absolutely can contribute to both a Coverdell ESA and a 529 plan, which the IRS officially calls a Qualified Tuition Program, or QTP, for the same beneficiary in the same year. They aren't mutually exclusive. Many families find that using both allows them to leverage the unique strengths of each account type as part of a broader education funding strategy. Okay, let's quickly recap the key takeaways for funding a Coverdell ESA. Individuals can contribute, but eligibility is tied to MAGI limits for education savings. Organizations have no income limit. The strict Coverdell contribution limit is $2,000 total per beneficiary per year. Key Coverdell ESA rules include cash contributions only, the ability to contribute for the prior year until the tax deadline, and contributions generally stopping at age 18. There's a crucial special needs exception removing age limits, and yes, you can contribute to both a Coverdell and a 529 plan simultaneously for the same child. Understanding these rules is your first step to effectively using this tool. So here's your action item for this segment. Take a few minutes later today to estimate your modified adjusted gross income. You can usually find your adjusted gross income on your latest tax return and check if any common modifications apply to you. IRS Publication 970 has details, or a quick search online for a MAGI calculator can help. Knowing your estimated MAGI is the essential first step to determine if you are eligible to contribute to a Coverdell ESA this year. Now, in our last segment, we really dug into the nuts and bolts of funding a Coverdell ESA. Who can contribute, those income limits, the MAGI limits for education savings we talked about, and that important $2,000 annual contribution cap per beneficiary. We covered the essential Coverdell ESA rules around getting money into the account. But let's be real, saving the money is just half the equation, right? The real magic happens when you actually use those funds to ease the burden of education costs. So today we're shifting gears to talk about spending smart, using your Coverdell ESA for qualified expenses. What exactly can you use this powerful savings tool for, especially to maximize those tax-free education savings benefits? One of the absolute standout features of the Coverdell ESA, and something that often surprises people, is the power of K-12 funding. That's right. Unlike many college-focused savings plans, a Coverdell can be a fantastic K-12 savings plan. You can use the funds for qualified elementary and secondary education expenses. Think kindergarten through 12th grade. This could cover tuition at a private or religious school, specific fees required for enrollment at a public school, you name it. For families considering options beyond their local public school before college hits, this is a game changer. How does that land with you? Does the ability to use tax-advantaged funds for K-12 needs change your perspective on saving for, say, private school tuition or maybe specialized academic support programs before the college years? It definitely broadens the possibilities. Now, of course, the Coverdell ESA absolutely covers higher education, too. So funds can be used for qualified expenses at eligible colleges, universities, vocational schools, and other post-secondary institutions. It's designed to support the entire educational journey for your beneficiary. But let's get specific. What falls under the umbrella of Coverdell qualified expenses? The IRS has a clear list. We're talking about the essentials: tuition and mandatory fees, books, supplies, and equipment required for enrollment or attendance. And remember that K-12 flexibility? For elementary and secondary education, the list expands even further. It can include computer technology like laptops or tablets, and related equipment and software if used primarily for the beneficiary's education. Internet access and related services, again if primarily for education. And even expenses for special needs services required by a special needs beneficiary. Think about your own situation, or the child you might be saving for. Which specific qualified expenses do you anticipate being the most significant? Is it the big tuition number? Or maybe the ongoing costs of tech, required books each semester, or specialized supplies for certain courses? Knowing what's covered helps you plan. Now, here's a key distinction from 529 plans that's really important to highlight. Generally speaking, room and board expenses are not considered qualified expenses for Coverdell ESAs. This is different from many 529 plans where room and board can be a qualified expense under certain conditions. So if you're primarily focused on saving for the full 4-year residential college experience, how does this exclusion of room and board impact your planning? It might mean you need to supplement your Coverdell savings with another vehicle, like a 529, or adjust your overall savings goals. Finally, there's one more interesting qualified use, using ESA funds for QTP contributions. A QTP is a qualified tuition program, more commonly known as a 529 plan. Believe it or not, contributing money from a Coverdell ESA into a 529 plan for the same beneficiary is considered a qualified expense. It provides a way to potentially consolidate funds down the road if needed. So, to wrap up this piece on spending, the Coverdell ESA offers fantastic flexibility covering both K-12 and higher education needs. That makes it a uniquely powerful K-12 savings plan alongside its college savings capabilities. The key is understanding exactly what counts as a Coverdell qualified expense: tuition, fees, books, supplies, required tech, and K-12 specifics like internet access, while remembering that room and board generally isn't on that list. All right, here's your practical step for this segment. Take a few minutes later today, maybe grab a notepad or open a digital note. List out the types of education expenses you anticipate for your child or beneficiary. Be realistic. Then compare that list to the Coverdell qualified expenses we just discussed. How closely do they align? This simple exercise can really clarify how a Coverdell might fit into your specific savings strategy. As we know with any financial tool, especially one with tax benefits, knowing how to spend the money is only half the battle. The other crucial half is understanding how to take the money out correctly, how to manage the account over time, and how it plays with other financial strategies you might be using. Getting this right is absolutely key to making sure you actually get those valuable tax advantages we've been talking about. So now we're shifting gears slightly to focus on exactly that: managing your Coverdell distributions, rollovers, and coordination. We'll cover how withdrawals work, what happens if plans change, and how to make sure your Coverdell fits smoothly into your bigger financial picture. First up, let's nail down how those tax-free education savings actually happen through withdrawals, or as the IRS calls them, Coverdell ESA distributions. The core rule is pretty straightforward. If the total amount you withdraw from the Coverdell in a tax year is less than or equal to the beneficiary's adjusted qualified education expenses for that same year, the entire distribution is tax-free. Boom. No federal income tax on that money. Remember, AQEE is basically the total qualified costs minus any other tax-free help received, like scholarships or Pell Grants. Think of it like matching puzzle pieces. If your qualified expenses piece is the same size or bigger than your distribution piece, they fit together perfectly, tax-free. But what if your withdrawal piece is bigger than your expense piece? Maybe you overestimated costs, or perhaps plans changed mid-year. If your total Coverdell ESA distributions for the year exceed the beneficiary's AQEE, then a portion of that excess withdrawal becomes taxable. Importantly, it's not the whole excess amount, just the earnings portion of it. Your Coverdell provider will send you a Form 1099-Q, which shows the total distribution and breaks out the earnings. You'll then need to calculate the taxable part. IRS Publication 970 has worksheets to help with this. It's definitely manageable, but it highlights why tracking those expenses accurately throughout the year is so important. Now let's talk about coordination, because Coverdell ESAs don't exist in a vacuum. Many families might also be eligible for education tax credits or use other savings vehicles. The key principle here is no double dipping. You can't use the exact same education expense dollars to claim multiple tax benefits. For example, let's say you're eligible for the American Opportunity Credit. If you take a tax-free distribution from your Coverdell ESA to pay for $1,000 of tuition, you must reduce your qualified expenses by that $1,000 before calculating your potential education credit. You can absolutely still claim the credit on other eligible expenses you pay, just not on the ones covered tax-free by the Coverdell. Similarly, if you use both a Coverdell and a 529 plan in the same year, and the total distributions exceed the AQE, you'll need to allocate the expenses between the two types of accounts to figure out any taxable portions. It requires a bit of strategic thinking. And this brings up a great point for reflection. Considering these coordination rules, how might you decide whether to use Coverdell funds or claim a tax credit if you have overlapping expenses in a given year? Sometimes it involves doing a quick calculation to see which approach yields the greater tax savings for your specific situation. Okay, let's move on to something really positive, the flexibility built into Coverdells. Life happens, right? Kids change their minds, maybe one gets a full scholarship, or perhaps circumstances shift. Thankfully, Coverdells have options. The Coverdell ESA rollover rules allow you to move funds from one Coverdell to another Coverdell for a different qualifying family member, think sibling, cousin, etc., as long as the new beneficiary is under age 30. You generally have 60 days to complete the rollover. You can also often just change the designated beneficiary on the existing account to another qualifying family member under similar rules, usually without triggering taxes. This isn't like some accounts where the money is rigidly tied to just one person forever. So, take a moment and think about your own family dynamics. How crucial is the flexibility to potentially change the beneficiary or roll over funds to another family member in your long-term education planning? For many, knowing this option exists provides real peace of mind. Finally, there's an important deadline associated with these accounts, the Coverdell ESA age limit. Generally, any assets remaining in a Coverdell ESA must be distributed within 30 days after the beneficiary reaches age 30. If the funds aren't used for qualified education expenses by then and haven't been rolled over to a younger, eligible family member, the earnings portion of that final distribution will be taxable to the beneficiary. The key exceptions here are for beneficiaries with special needs. The age limit doesn't apply, or if the account was properly transferred or rolled over before that 30th birthday hit. It's a critical date to keep on your long-term planning calendar. And managing these distributions effectively over the years really boils down to good record keeping. So maybe ask yourself, what strategies could you use to track expenses and distributions carefully to maximize the tax-free education savings benefit and avoid unexpected taxes, especially as that age 30 deadline might eventually approach? All right, let's quickly recap the key takeaways for managing your Coverdell ESA. First, Coverdell ESA distributions are tax-free when they don't exceed the year's adjusted qualified education expenses. Second, if distributions do exceed AQEE, the earnings portion of the excess is taxable, so track carefully. Third, remember the coordination rules. No double dipping with tax credits like the American Opportunity Credit or other savings plans. Reduce expenses accordingly. Fourth, leverage the flexibility. The Coverdell ESA rollover rules and beneficiary change options can be lifesavers if plans change. And fifth, keep that Coverdell ESA age limit of 30 on your radar for long-term planning. Now, for your action item based on today's discussion. If you plan to use multiple education savings tools or tax benefits, familiarize yourself with the coordination rules in IRS Publication 950 to optimize your strategy. Taking a little time to understand how these different benefits interact can really help you make the most of your tax-free education savings potential and avoid any surprises down the road. You can find Publication 970 easily on irs.gov, and that brings us to the end of our deep dive into the Coverdell Education Savings Account. Wow, we covered a lot of ground today, didn't we? We started with Coverdell ESA 101, defining this powerful tool and its potential for tax-free education savings. We then navigated the specifics of funding the account, looking closely at the Coverdell contribution limits, that $2,000 annual cap per beneficiary, and the crucial MAGI limits for education savings that determine who can contribute. A big focus, and something I think is really valuable for many families, was understanding the Coverdell qualified expenses. We talked about how this isn't just for college. Its use as a K-12 savings plan for elementary and secondary school costs is a major advantage. Finally, we explored managing the account, including Coverdell ESA distributions, rollover rules, and the importance of coordinating with other benefits to maximize those tax advantages. Two things really stand out for me from our discussion: the incredible benefit of that tax-free growth and withdrawal specifically for education, and the flexibility this particular education savings account offers for those earlier K-12 years, costs that can sneak up on you. Understanding tools like the Coverdell ESA really helps you seize financial control when planning for those significant education expenses, building towards that lasting legacy for your family. Thank you so much for tuning in and being part of the Safe, Simple, Sound community today. I truly hope this breakdown gives you the clarity you need to evaluate if a Coverdell ESA fits into your financial picture. For links to resources, including IRS Publication 970, which we mentioned, head over to our show notes. If you found this episode helpful, please consider leaving us a review or sharing it with a friend or family member who might be navigating education savings. And don't forget to subscribe so you won't miss our future discussions. Until next time, stay informed, stay empowered, and keep making those safe, simple, and sound financial choices. This is Sam, signing off.